Here's something that'll blow your mind. 89% of investors have absolutely no idea what market capitalization actually means, and it's costing them thousands. I'm not talking about some obscure finance term that doesn't matter. Market cap determines everything. Your risk, your potential returns, whether a stock can even deliver the gains you're hoping for. Yet most people think a $50 stock is more expensive than a $10 stock. Dead wrong. That's not how any of this works. Today I'm breaking down the 3 biggest market cap mistakes that are sabotaging your portfolio right now. Plus, I'll show you exactly how the smart money uses this metric to spot winners in 2026. Stick around till the end, because I'm revealing the one market cap category that historically crushes the market. Let's dive in. Okay, first things first. What is market capitalization? In the simplest terms possible, it's the total value of a company. Here's the formula. You take the current stock price and multiply it by the total number of shares outstanding. That's it. That's market cap. Let me give you a real example. Say Apple stock is trading at $180 per share in June 2026, and they have about 15 billion shares outstanding. Multiply those together, and you get roughly $2.7 trillion. That's Apple's market cap. That's what the market says Apple is worth as a company. Now here's where people get confused. They think stock price equals company size. Huge mistake. A company with a $100 stock price could be way smaller than a company with a $20 stock price. The stock price alone tells you nothing. What matters is the total value. How many slices of pizza exist and what each slice costs. That gives you the value of the whole pizza. So why does market cap size even matter? Because it completely changes your investment strategy. Different sizes behave totally differently. Let's break down the categories. Large cap stocks are companies worth $10 billion or more. These are your Apples, your Microsofts, your Amazons. Mid-cap stocks range from $2 billion to $10 billion. These are established companies that still have room to grow. Think companies you've heard of but aren't household names yet. Small cap stocks are under $2 billion. These are younger, riskier companies. Higher potential returns, but way more volatile. Here's the thing nobody tells you. Large caps are stable. They're not going to double overnight, but they're also not going to disappear. A $2 trillion company cannot easily become a $4 trillion company. The math just doesn't work. There's not enough money in the world for every large cap to keep doubling. But a $500 million small cap, that can become a $1 billion company. Then $2 billion. The percentage gains are massive. Of course, it can also go to zero. That's the trade-off. Higher potential reward, higher potential risk. This is critical to understand. Now let's talk about mistake number 2. Building a portfolio with zero attention to market cap diversification. This is portfolio suicide. In 2026, I see beginners making the same error. They buy 10 stocks, all small caps, because someone on social media said they'll moon. Then the market gets choppy, and their entire portfolio tanks 40%. They panic sell. They lose money. They blame the stock market. But it's not the market's fault. It's a diversification problem. All small caps move together when things get rough. You've got zero protection. Smart investors mix it up. Some large cap stability. Some mid-cap growth potential. Maybe a small position in small caps for that lottery ticket upside. This brings me to the third massive mistake. Assuming higher stock price means better company. I cannot stress this enough. Price per share is meaningless. I've seen people refuse to buy Amazon because it's, quote, too expensive at $150 per share. Then they buy some random penny stock at $3 because it's cheap. That's backwards thinking. Amazon at $150 could be undervalued if the market cap justifies it. The penny stock could be overpriced even at $3. Stock splits prove this perfectly. When a company does a 10-1 split, the stock price drops 90% overnight. But did the company get 90% less valuable? Obviously not. You just own more shares at a lower price. The market cap stays identical. The company's value hasn't changed one penny. Here's what Wall Street doesn't advertise. Market cap effects, which institutional investors can even buy a stock. This is huge. Most big mutual funds and pension funds have rules. They can't invest in companies below certain market cap thresholds, usually $1 billion or $2 billion minimum. So when a small cap crosses that threshold and becomes mid-cap, boom, suddenly billions of dollars of institutional money can flow in. The stock often surges. This is called the index inclusion effect. When a company gets big enough to join major indexes like the S&P 500, index funds have to buy it. Automatic demand. Some investors specifically hunt for companies approaching these thresholds. It's a legit strategy if you know what you're doing. So what should you actually do with this information? Here's the smart money approach for 2026. First, always check the market cap before you invest. Not the stock price, the actual total company value. It takes 5 seconds. Second, match your market cap choices to your risk tolerance. Conservative? Focus on large caps. Want growth? Add mid caps. Feeling adventurous? Small position in small caps. Third, understand that different market caps dominate at different times. In bull markets, small caps often crush it. In bear markets, large caps hold up better. The absolute best portfolio for most people? A core of large cap stability with some mid cap exposure for growth. Keep it simple but diversified. And here's the kicker. Historically, small cap value stocks have delivered the highest long-term returns, higher than large caps. But you need patience and a strong stomach. The volatility will test you. You'll see 30% swings. But if you can handle that and stay invested for 10 plus years, the data is compelling. Bottom line, market cap isn't some boring technicality. It's fundamental to building wealth. It tells you what kind of investment you actually own. Stop looking at stock prices in isolation. Stop building undiversified portfolios. Stop ignoring market cap when you research companies. If you found this valuable, smash that like button right now. Subscribe to Operation Wealthy so you never miss our weekly money strategies. Turn on notifications. Drop a comment telling me your biggest market cap question. I read every single one, and your questions shape future videos. If you enjoyed this, you won't want to miss our next video about the 5 ETFs that are crushing the market in 2026, including one that's up 43% year to date. See you there.